Emeric Paul from Access Capital Partners out of Paris to come at it from a European lens. Emeric's background, his qualifications in politics and finance, and sits on a number of advisory committees across a number of assets, pan-European assets, on the infrastructure side, and has worked in and around infrastructure and private equity in Europe for about 20 years. So please welcome to the stage Emeric Paul.
Good afternoon. Thank you for your time today. Jeff earlier on made a great job presenting the attractiveness of the private asset class on a global scale. I have maybe a slightly easier job on focusing on this subset of this very large universe by introducing the attractiveness of the European buyout on infrastructure asset class. I'll start with a couple of words on the European infrastructure landscape. Europe is the second largest economy in the world. It is an aggregation of 30 countries. It has roughly 440 million customers, 23 trillions of GDP, and most importantly, a very large reservoir of SMEs. We have over 1 million SMEs in Europe, and this is extremely good material for M&A activity on consolidation plays, either on a domestic level or across countries in Europe. Good news about these M&A transactions that are being done in Europe and done by GPs is that they are typically done at attractive valuations. When you compare the median EV over EBITDA multiple for European transactions, you're typically 1 or 2 turns below the median EV over EBITDA multiple of the US. Good thing as well is that we have a very wide diversity of managers with different specializations looking at these assets for acquisition. We have close to 2,000 managers looking at acquisitions there. Now, if I look at the buyout market, there is a segment of the market that we find particularly attractive, and that is the lower end of the market. It is the part of the market that has the highest density in terms of number of managers. We have about 600 fund managers focusing specifically on the European small cap market. On the value creation play in the small cap market is particularly attractive. It is all based on growth, GDP growth. And this growth is actually quite typical for smaller companies, as we've discussed earlier on. And there are many levers that can be activated to generate that growth. I mean, it could be through consolidation, could be through influence on a manager that is easily done on a smaller company than on a super large company. It is also a value creation play that intensively relies on strategic value creation. Basically, the name of the game there is to bring a company from a relatively small scale, maybe a domestic activity, and actually consolidate that company with acquisitions and make it a multi-country player. And this is triggering usually fairly attractive multiple arbitrages. The value creation play is not about financial engineering and high use of leverage. The typical the typical net debt over EBITDA multiple that we find in the smaller end of the market is around 3 times EBITDA. The other key benefits that we see in the mid-market buyout space in Europe is that it is a very liquid market. You're not dependent on the credit market or the IPO market to get your exits done in that part of the market. You're basically benefiting from a wide pool of potential acquirers. These are strategic acquirers, could also be financial acquirers. We are benefiting from a large universe of mid-market managers and large cap managers that are actually looking for these smaller targets. And if I take an example from our portfolio, we run a small cap private equity fund of fund portfolio. Last year we had 60 exits, so we basically have 25 exits or around 25 exits per semester in this small cap segment, whereas the larger end of the market has been completely silent over the past 2 years, with no distributions made to, or very limited distributions made to LPs. Now, if we look at the performance of the small cap buyout segment, I think we should first look at the underperformance and compare the underperformance of small cap buyout on the one hand and large cap buyout on the other hand. And you can see that they're roughly similar. So you have 22% of the small cap and mid cap buyouts that are generating less than 1 times, and 19% of the large cap buyouts that are generating less than 1 time. So I think the idea that the small cap segment is riskier than the large cap one is a bit of a myth. What is not a myth, though, is the outperformance that is being generated by the small cap deals. If you look at the number of deals that have been generating above 3 times, you have 35% of deals that are small cap deals that have been generating multiples above 3 times, against only 22% of the large cap buyouts that have been generating that sort of return. If you look at the ones that have generated over 2 times, that's 58 against 40. Another way to look at it is the performance of the small cap buyout funds compared to the mid cap buyout funds and the large cap buyout funds. And what we could look at is the threshold to be top quartile for the funds. And what it means is that what's the minimum performance that you need to achieve to be part of the 25% best performing funds of your vintage. And what you can see on this graph at the bottom left-hand side is that consistently across vintages, the threshold to be top quartile has been higher for small cap funds compared to mid-market funds or large cap funds. I'll stop there with small cap buyouts. I'll cover the other part of the European market that I wanted to cover, which is the infrastructure market. And here, I mean, we're no longer speaking about outperformance necessarily. We are mostly focusing on stable returns. Infrastructure has the capacity to generate robust cash flow predictability. These assets are long-dated assets. They're typically monopolistic or quasi-monopolistic assets, and therefore, for these assets, you can see your revenue streams over a long period. And this asset class is one where you benefit from a low level of correlation with other asset classes. I mean, it is far less volatile than the listed shares. It is also compared, for instance, to real estate, less volatile than real estate. Real estate is more exposed to GDP variation, which is not the case for, let's say, I don't know, a bridge or a road or a fiber network. So you have this very interesting decorrelation play that you can get with infrastructure. And you also benefit from assets that are producing a strong indexation to inflation. So you get revenues that are very often indexed to inflation, providing a protection. For a number of infra assets, also the capacity of generating cash yield. If you look at the European situation, Europe infrastructure market is benefiting from very powerful megatrends around digitalization, around energy transition, and around decarbonization of transport. These trends are there to stay. Europe does not produce any fossil fuel, so you have a massive need for investments in renewable energy in Europe. Europe is increasingly focusing on data sovereignty, and that implies a number of investments around data centers and therefore around fiber, but also around the energy that is consumed by these data centers. So these mega trends are super powerful. You get a lot of support from the governments around infrastructure. And you can see when Brexit occurred, number of continental European countries were trying to attract businesses from the UK, and the first thing they were promoting is the quality of their infrastructures. So there is this strong support. The catch is that governments have no money in Europe. They're all dealing with very large budget deficits, and therefore this is making the European market the largest market in the world for private investments in infrastructure. It is consistently above the US market, as you can see from the chart on the bottom right-hand side. Sorry. Just to finish up on infrastructure, the segment that we feel is most interesting in infrastructure is, again, the small and mid-market segment. It is a segment that historically has represented around 90% of the deals, but it is a segment that is currently underserved by infrastructure GPs. The reason for that is that they've been very successful over the past 10 years with their infrastructure investments, and they've grown very substantially in size. A manager that was managing €1 billion in 2008 probably manages 7 to 10 billion euros, if not more, today. And therefore, this has created a bit of a vacuum in the mid-market and an opportunity to get access to mid-market assets in a less competitive environment at more attractive prices, and to put to play the value creation game plan I referred to earlier, which is basically growing the assets, organizing external growth as well as organic growth. I'll probably stop there on infrastructure and conclude with the view that if you're not exposed to European buyouts, small cap buyouts, or European infrastructure, it is probably now the right timing to do so. Thank you.
Thanks, Emmerich.